owning most of its stores, manufacturing facilities, and transporting the products by itself. Greggs is a vertically integrated leading bakery retailer in the UK. Due to its high popularity with the low and middle-income customers, a friend of ours with boots on the ground jokingly said that the country would fall apart without Greggs. This is precisely what has been happening to the stock price, however. It is only January, but Greggs' valuation is already down 26% year-to-date. The market had become accustomed to the company's high double-digit revenue growth rates, and apparently didn't like to hear that Q4 total sales were up just 7.7%. And while the company has more cash than debt on its balance sheet, and its growth runway is far from over, this Elliott wave chart suggests that the bears are not done with Greggs yet. It shows that this month's crash fits in the position of wave C within a 3-wave correction following a complete 5-wave impulse to the upside spanning more than 2 decades. Greggs' journey as a public company began in the 1990s and culminated in late 2021, when the stock climbed to a record high of 3,443 pence a share. That uptrend produced a 5-wave impulse pattern, which we've labeled 1, 2, 3, 4, 5 in brackets. 2 lower degrees of the trend are visible within wave 3, as both its own subwaves and the subwaves of its 5th wave can be recognized. And just as wave 4 erased almost all of the extended wave 5 of 3, we can expect the current correction to do something similar to wave 5. In other words, it makes sense to expect more weakness in wave C towards the 1400 to 1300 support area before the bulls can return. From the current price of roughly $20.50, that'll be another 30 to 35% to the downside. Once there, we think Greggs would be a real bargain and a high-quality long-term investment. We remain on the sidelines until then.